without statements of changes in equity, presents a reconciliation for the accounting period of the beginning balance for each component of equity to the ending balance. Each change is disclosed separately in the statement. The following are the common changes in the equity component balances during the accounting period. Net income will make the retained earnings rise. Net loss and retained earnings lose, mean decrease. Distributions to owners, dividends, retained earnings will decrease. And issuance of common stock will make common stock rise. Issuance of common stock person above a par will make additional paid-in capital rise. Total change of other comprehensive income, OCI, will make accumulated OCI decrease or increase. Repurchase treasury stock will decrease total shareholders' equity. Understatements of retained earnings. The statements of retained earnings reconciles the beginning and ending balances of the account. This statement is reported as part of the statement of changes in equity in separate column. The following is a common example of retained earnings reconciliation. Retained earnings beginning balance, add net income or loss for the period, then minus dividends distributed during the period, and add positive or negative prior period adjustments. And then we will get the retained earnings ending balance. About the prior period adjustments. Prior period adjustments include the cumulative effect on the income statements of the following two items: changes in accounting principle, for example, change in inventory valuation method, corrections of prior period financial statements errors. These items require retrospective application. Adjustment of the carry amounts of assets, liabilities, and retained earnings at the beginning of the first period reported for the cumulative effect of the new principle or the errors on the prior periods. Corrections of prior period errors and the cumulative effect of changes in accounting principle must not be included in the calculation of current period net income. Changes in accounting estimate are not prior period adjustments. Examples include a change in the percentage used for the estimation of credit losses, or the change in the estimated remaining life of a depreciable asset. Changes in accounting estimate require prospective application. The effect of the change is accounted for only in the period of changes and any future period. And now we will pay attention to the common and preferred stock. The most widely used classes of stocks are common and preferred. If only one class of stock is issued, it is treated as common, and each shareholder must be treated equally. The following basis terminology is related to stock. As you can see on the table here, authorized will be maximum amount of stocks that a corporation may issue. When the stock term is issued, stock that has been sold to stockholders by the corporation. And when stock term is outstanding, it means stock currently held by stockholders. The common shareholders are the owners of the firm. They have voting rights, and they select the firm's board of directors and vote on resolution. Common shareholders are not entitled to dividends unless declared by the board of directors. A firm may choose not to declare any. Common shareholders are entitled to receive a liquidating distribution only after all other claims have been satisfied, including those of preferred shareholders. Common shareholders ordinarily have a preemptive rights. Preemptive rights give current common shareholders the right to purchase any additional stock issuances in proportion to their ownership percentage. This way, preemptive rights safeguard common shareholders' proportionate interest in the firm. Preferred stock has the features of debt and equity. It is classified as an equity instrument and represented in the equity section of the firm's balance sheet. Preferred stock has a fixed charge, but payment of dividends is not an obligation. The payment of dividends is at the firm's discretion. Preferred shareholders tend not to have voting rights. Preferred shareholders have the right to receive dividends at a specified fixed rate before common shareholders may receive any. Distribution before common shareholders but after creditors in the event of the firm bankruptcy, liquidation. The following are common features of preferred stock. Cumulative preferred stock accumulates unpaid dividends, called dividends in arrears. Dividends in arrears must be paid before any common dividends can be paid. Holders of convertible preferred stock have the right to convert the stock into shares of another class, usually common stock, at a predetermined ratio. Treasury stock is the entity's own stock that was repurchased by the entity subsequent to its initial issuance to shareholders. Treasury stock reduces the shares outstanding, not the shares authorized. Dividends are never paid to the shares. Equity transactions. Issuance of stock. The par value of stock is an arbitrary amount assigned by the issuers. Common and preferred stock are reported in the financial statements at par value. Additional paid-in capital in excess of par, is increased for the difference between the cash receivable and the par value of the stock issuance. Treasury stock. Treasury stock is reported using one of the two methods. The first is under the course method. Treasury stock is recorded as the course of the purchase. Treasury stock is treated as a reduction of total shareholders' equity. And the second, under the par value method, treasury stock is recorded for the par value of the stock. Treasury stock reduces total shareholders' equity. Additional paid-in capital is reduced, and retained earnings is decreased if the acquisition price is greater than the original issue price. We should pay attention to some notes. Treasury stock has no voting rights, receives no distribution in liquidation, and receives no dividends when the entity declares dividend. About the cash dividend, the most common form of dividend is the cash dividend. An entity declares a dividend based on a dollar amount per share. Each shareholder receives cash as a form of distribution. On the declaration date, the board of directors formally approves a dividend. A declaration of a dividend decreases the retained earnings account. All holders of the stock on the record date are legally entitled to receive the dividend. There is no impact on the firm's accounting equation on the record date. The payment date is the date on which the dividend is paid. Property dividend. When an entity declares a dividend consisting of a tangible property, first, the property is remeasured to fair value as of the date of declaration, and any gain or loss on the remeasurement is recognized in the statement of income. Second, the carrying amount of retained earnings is decreased for the fair value of the property to be distributed. And third, the property is distributed as a dividend. Stock dividends and stock splits. A stock dividend involves no distribution of cash or other property. Stock dividends are accounted for as a reclassification of different equity accounts, not as liabilities. The accounting for stock dividends depends on the percentage of new shares to be issued. Small stock dividend. An issuance of shares less than 20% to 25% of the previous outstanding common shares should be recognized as a stock dividend. Large stock dividend. An issuance of more than 20% to 25% of the previous outstanding common shares should be recognized as a stock split in the form of a dividend. In accounting for a stock dividend. The fair value of the additional shares issued is reclassified from retained earnings to common stock at par value as a difference to additional paid-in capital for a stock dividend. That is accounted for as a stock split in the form of a dividend. The par value of the additional shares issued is reclassified from retained earnings to common stock. Stock splits are issuances of shares that do not affect any aggregate par value of shares issued and outstanding or total equity. Stock split reduces par value of each stock and increases the number of shares outstanding. No entry is made and no transfer from retained earnings occurred. The primary purpose of stock splits a stock split is to improve the stock marketability by reducing its market price and proportionally increasing the number of shares outstanding. And now, we will come to statement of changes in equity. The purpose, uses. And now, we will come to the purpose and uses of statement of changes in equity. The purpose is to reconcile the changes in the various equity occurs from the beginning of an accounting period to the end of the accounting period. And it uses to understand the change of the owner's claim to the net assets, assets liabilities, assets minus liabilities of an entity, and to understand the portion of equity representing the investment of shareholders paid in capital versus the amounts earned by the entity on behalf of the investors, retained earnings. But everything has its limitations. Stats laws can cause the differences. Terminology variations can cause confusion and use management decision and analysis to fully understand. Now, we will change